All right, welcome to How to Trade Correlations in Forex Markets. My name is Jason Pfaff. I am a Nadex educator and analyst, and this is what I got to be honest, one of my favorite topics. Thanks to each of you for hanging out with us for a little bit here. Hopefully share some things I've learned about Forex and correlations and ways to look at different markets. And one of the things I love about Forex and specifically this topic is there's always more to learn. And as I've picked up things at different places on Forex markets and trading in general, I absolutely love to understand how markets work and why different markets and different currency pairs correlate, why they move in tandem, why those correlations sometimes break down. And then obviously there's a strategic part of it, right, where we want to understand to improve our own trading and look at different angles and unique opportunities with respect to trading. And correlations is certainly one of those ways to do that. So thank you for joining us. I am, as I said, really excited about this topic, one of my favorite topics. Please, now or throughout the broadcast here, feel free to drop some comments, some questions, thoughts, ideas, feedback in the chat box. I'll be checking that periodically, so please use that. It's there for you. Love any engagement from you and ideas and feedback and questions you want to share. If there's something in particular, or if you've got a question about two markets you think might historically have correlated, just fill it up in the chat box and I'll work my way through each comment as we go. First, and this is always really important, take a look at the risk disclaimer. Certainly want everyone to be aware trading does involve financial risk and might not be appropriate for everybody. Certainly want you to understand our time today is purely educational, informational, certainly not a solicitation for any type of financial instrument. And then we're going to look at a lot of charts today and, past history with respect to different markets and different currency pairs, et cetera. Just want to make sure everybody knows that past performance is certainly not indicative of future results. We'll leave our disclaimer up here for another minute. Or maybe that was a little less than a minute there, but hopefully everybody got a chance to view that. So as I said, my name is Jason, and I think one of the reasons why I love this topic so much, and it really is also one of the reasons why I enjoy doing things with Nadex traders and in support of the Nadex community, is the range of markets. On Nadex, you've got the opportunity to scan so many different markets and trade contracts across different time horizons. And with respect to my background, and I've been very fortunate to work in some unique areas and forecast different things, whether it's a country's GDP or future forecasts of Forex rates, looking at currency pairs or correlations allows us to put some of those disparate markets together, allows us to, as I said earlier, understand markets better by understanding what other instruments or markets may a certain market move in tandem with, or might it be impacted by, or maybe there's a common variable that moves two very different markets in the same way. So I'm an independent analyst and educator for Nadex, and been doing that for some time now. And again, sharing about Forex and things I've learned, and being able to tie that together in formats like this, and again, talking about different markets. Certainly something I love to do. So again, thanks for joining us. Thanks for being a part of this. If you've not been on a Nadex webinar before, I really invite you to go out to the YouTube channel. Favorite it, just plug in. Tons of great resources, all different kinds of webinars. You got some like this that kind of covers some strategic pieces. You've got some orientations to the platform. There's a great webinar out there, on candlestick charting and how to read candlestick patterns. So definitely check out the YouTube channel. This webinar will be archived later on the YouTube channel. Like I said, I just favorite it so you get, updates as additional content. Nadex is doing a great job of always adding content. It's not all necessarily Nadex specific. It's just resources for traders. Also, as you start to take some of that content in and sharpen your skills as a trader, I would certainly encourage you to take advantage of the free and permanent demo account, nadex.com/demo. Takes 2 minutes to register for the account. It's free. They'll stack it with some virtual money. You'll be trading markets live just like you would be with a regular permanent account. So you could check out some of these correlation strategies, or you can take in some other resources that Nadex puts out there, try some different strategies. I did a webinar a couple of weeks ago on technical indicators. I did one on Ichimoku, and I really encourage folks, as you encounter that content, practice, learn more, see what works, see what you're comfortable with as a trader, and always be looking to sharpen your skills. So today we're talking about correlations. So a couple of things that we want to cover. What are correlations? Why do they occur? How do we find them? How do we know that they are happening? And then when and why would you trade them? One thing I want to make sure you tuck in the back of your mind, and I promise there's not going to be too much math here on the webinar, although if you have some questions about the math, feel free to ask. I'm happy to discuss that too. Correlation doesn't necessarily equal causality, and that's why I really will encourage as we go, and encourage you as you think about trading based on correlations. You want to make sure you've got, to the best of your ability, you want to ensure that you've got a legitimate correlation. There are times two things just move in tandem because they're both moving in the same direction. If you've got two markets that are going up, and I guarantee you in the world there's two markets right now and where people are trading something, that they're both going up, doesn't necessarily mean that they're correlated. So you want to really study, we'll talk about this as we go, but to make sure that just because they're correlated does not necessarily mean there's an actual relationship or there's an actual causal relationship. What we'll talk about today is, well, we want to understand on some level why things are correlated so that we know that there's a legitimate connection between those two markets. I encourage new traders and more experienced traders as well. If you can't explain your trade and why it may work, and just as importantly, why it may not work in one sentence or less, you probably need to do some more homework. And so we will want to get to a point as we look at these correlations later where we'll want to explain why the yen and gold might have historically moved in correlation, right? So we'll look at that as we go. But as I said, these 4 questions really are the bulk of our webinar, and it's the what, the why, the how, and the when of trading correlations. So a couple of notes right off the top. So correlations should be visible. And I've kept this kind of chart platform agnostic. I use TradingView. You'll see some of my screen grabs are from TradingView. Incidentally, I've got a webinar on Monday where we're going to talk about momentum and trends and how to build a trading strategy around momentum and trends. I'll use a little more of the Nadex platform for that to show you some examples actually from the Nadex platform of trading based on momentum. Sign up for that webinar if you can make it. Would love to have you there. But regardless of your trading station, trading package, how you're set up, every trader is a little bit different. You should have the ability to trade or to chart 2 different assets at the same time, do some type of overlay. So we'll look at how, I've done that in TradingView, should be able to extrapolate that to your trade station. But the main point here is that a correlation should be visible. If someone has told you, hey, these 2 things are historically correlated, or you think they might be correlated based on just your cognitive understanding of how that market should work, you still want to be able to look at a chart and see it for yourself and understand that pattern of movement. You should also be able to measure a correlation. I'll show you an example of a correlation table, and I'll show you an example of a calculator here in our time today. You should be able to measure the strength of that relationship. You don't want to just see, you want to see it, but you also want to say, okay, so I know these 2 pairs are, correlated, 85% of the time, right? If you're talking about euro dollar and pound dollar, that's an 85 to 90% correlation. That means, the strength of the relationship, those things move in tandem to the tune of 85, 90%. you want to have that knowledge as a trader. Is you're comparing markets to trade, you're comparing potential correlation trades you want to make. You want to know not just that I can see it, but here's the calculator is telling, or the correlation table I use is telling me, my tools are telling me, here's the strength of the relationship. Also, and we'll look at an example of this, correlations cut both ways. Some of the strongest correlations in markets are actually what you would refer to as an inverse correlation, where two assets move in opposite directions. One interesting inverse correlation that's a bit in the news because of kind of the volatility that we've seen across U.S. stock indices is the impact of 10-year yields from the Treasury, the 10-year Treasury yields, and let's say the Nasdaq. Actually had a chart in a article I published this morning on Nadex Market News. You can go out to the Market News tab of the Nadex website and check out the article. And we see an inverse correlation. When yields go up, the Nasdaq has gone down, and vice versa. When yields come back down, you see the Nasdaq go back up. And that's really been, one of those inverse correlations that's certainly been top of mind. Is the Nasdaq has certainly been on the move through the last week or so. All right, so a couple of our key concepts here with respect to correlation. First of all, and these are kind of some assumptions you just have to be willing to make to trade based on correlations. You have to basically assume that assets can move in tandem. Maybe it's across different time horizons. Maybe it's seasonal. Maybe it's who knows what. But you have to be comfortable with that idea to be able to do that. For those things to be related, they have to share some type of common variable. Maybe there's an event impacting both. Maybe these are two things that haven't always correlated, but something recent has happened that impacts them both the same. And number three there, sometimes the assets are more directly related. So aside from maybe an event impacting both, maybe there's just two different currency pairs that both share the dollar as part of their pair, right? Like I was saying earlier, euro dollar and pound dollar are historically well correlated. Well, they both share the dollar, and the dollar is probably the stronger of those two pairs, and kind of dictates the direction and movement. In addition, the other side of that is the pound and euro are well correlated and face a lot of the same economic issues as well. So sometimes there's a really close relation that makes a lot of cognitive sense when you first look at it, right? Like I think most folks would agree, that example I just used, yeah, the euro, the pound, and the dollar should all move relationally. And again, sometimes things are not quite as easily understood to, maybe a pedestrian without experience in the markets. Like I was saying earlier, interest rates and tech stocks, not everybody would be able to bridge that link and understand why those things are inversely correlated. You as a trader know that, interest rates have economic impacts, and tech stocks, high growth stocks might be impacted by those in the minds of traders, et cetera. But it's not as a close link as that euro, dollar, pound example. Okay, so there's a couple ways to find correlations. We'll look at some of these examples here. One is your charts, and again, I'll be using TradingView. You can use your chart package du jour. You should have some correlation and overlay capabilities. Incidentally, if you're having trouble with your TradeStation, or you want some ideas on some other charting that you can use to find correlations, please feel free to email me, jason@thedutchbook.com. I'll also put up a slide at the very end where you'll have my contact information. Please reach out. Please let me know if you need any help, have any questions about how to set up some of the things we talk about. Last thing I want is for you to get excited about maybe trying some of the stuff we talk about, and then you get back to your personal setup and you can't exactly string it together like we talked about. So please feel free to reach out. So your charting package is key. We'll talk about some external resources like calculators and tables. And then the third, and I think sometimes folks understand this or miss this opportunity. Some of the best trading ideas that traders I work with is just a result of your own reading and brainstorming. Clearly, you're going to want to do some research and validate the ideas you generate, but I think a really underrated exercise for a lot of traders, and everybody's got a different style, right? You may scalp 5-minute binaries on Nadex. You may be a more long-term trader, trading a weekly, but take some time and generate some ideas. Step away from the laptop. Maybe it's after you're done for the day. Maybe grab a trading buddy. And with respect to correlations, our topic today, think about some assets that might correlate conceptually. Some things that might be impacting. Maybe you see something coming down the pipe in the news flow. There's an event next month, and just think about some, possible pairs or correlations, and then go research that, read up on it, see if it's an actual link. So that fundamental research there, that third step of possibly finding some correlations, it's just you reading and thinking and again, maybe dialoguing with some other traders. All right, so slide 8, we are looking at dollar yen, one of my favorite pairs. So, as simple as this seems, just, make sure, again, you set it up in a way that's comfortable for you. You're going to have, I use candlesticks and a colored line. But you want your main asset there and then maybe another market. I believe this is also gold, but we'll look here at an example in a second. So you just want to look at, you just want to look with your naked eye at, 2 markets or 2 assets or 2 currency pairs, and just look at the lines and see how well they match up, right? Like you want to look over short time horizons, long time horizons, just, work through it a little bit and put your own insight into it. The other is, and this is at the bottom in the red, and use some type of correlation indicator, right? So all I'm using here is just an indicator of what you call the correlation coefficient, or basically the percentage to which these 2 assets correlate. Obviously, the higher or more positive that is, the more positive or stronger correlation you have. If it goes negative and is consistently negative, that's the inverse correlation we were speaking to earlier. If something's all over the place, then there's not much of a relationship to speak of. So let's take a look at some examples. Okay, so this is euro dollar, pound dollar, the example we were talking about a second ago. So just orient here to the chart. The candles are euro dollar. The blue line is pound dollar. And just orienting here, this is clearly an example of 2 currency pairs that are correlated. We can also look at our correlation coefficient indicator at the bottom. I would say anything regularly above a 50% or a 0.50 has a relationship that you would at least want to pursue knowing more about and potentially being able to build a strategy around. There's more art than science to some of this, I promise you. So your own level of correlation and linkage is ultimately going to be up to you. You're executing the trade. The way I think of it, anything above 70 is really solid. Anything above 50 is worth investigating more. Also, just a word of caution, make sure you're looking at different time frames. There's some things that correlate very well over, a week or a month. There's some things that correlate almost tick for tick. So where you may look at a weekly or a monthly between 2 assets and there's not a strong correlation, but you may really narrow down over the last 2 weeks and look at a tick chart and see over the last 2 weeks there's been something in the environment that have those 2 pairs correlated much more closely. Okay, so this is an example of an inverse correlation as we are speaking to that potentiality. This is dollar yen and gold. So dollar yen is historically inversely correlated with gold. As currency traders, but it's always helpful to remember or to be reminded, in your charting program, you should be able to flip, yen dollar and you would get then a perfect correlation. Now, again, 99% of the time you have to trade at dollar yen, but if it's simpler for you to look for correlations, even if it's inverse, and just flip the pair from its more conventional notation, you can do that too. I kept it here to show it inverse as an example of inverse, but for instance, if you trade certain commodities in other countries, and you want to check a positive correlation between that currency and the commodity in question, it's and the dollars, always first. You can always, just for your charting purposes, flip it so that it's, if it's again, in this case is a good example, yen dollar, then it would show as a positive correlation. So this is, again, historically example of an inverse correlation between two markets. And this is one of the more traditional, well-regarded correlations that we have in markets. Gold correlates with several different things. Yen correlates with several different things. The yen and gold are typically linked, and also, this isn't charted, but the yen and the Nikkei historically, traditionally, move inversely as well. And so one of the things we were going to do in this part of this webinar is talk about, just some of the concepts so you can start to identify some of these for yourself. The yen and gold are historically seen as quote unquote safe haven assets in a time of volatility or, market disruption, the market's roiled, or there's a geopolitical, outbreak of, something in, maybe in the Middle East or in Asia or, North Korea, a couple of years ago was really a perilous situation. You'd see the yen spike, gold would spike, safe haven asset, historically speaking. Again, as we remember back to our disclaimer, past history, no indication of future results, but this is something that, most market participants would say is a time-honored traditional relationship. Those safe haven assets will then receive demand at a similar time, or if there's a real risk-on mood or sentiment in markets, there may be less interest in the yen, less interest in gold. Stocks are, ripping through the roof. Your yield on yen, it's a non-interest-bearing asset, pretty stable, which is why it's attractive in times of turmoil, but it works against it from a demand perspective in times of, just really roaring economic through the roof success. So the yen and gold are both treated in a similar way like that by the markets. So you'll see this inverse correlation with dollar yen or a positive correlation with yen dollar and gold. So this was one of these classic correlation trades that traders will flock to. Some crazy geopolitical story pops on the terminal. That historically you've seen the yen and or gold get a bid at that time, and those two can move in tandem as a result. That's just one example. And again, as I said, the Nikkei as well. The Nikkei and the yen are historically inverse as well. It's not quite as strong as the relationship between yen and gold, but again, maybe is one of the first things you look at after we're done here to kind of start building some strategies or just trying out some things on your own charting program. You can look at the Nikkei and yen historically inversely correlated as well. So here, actually I did. Sorry. So here's the yen and the Nikkei. What's interesting about this is why I wanted to include this one. Almost forgot I included it. This is a historically strong correlation. You can see it on the right side here. It started to break down a little bit, right? Not quite as strong as it has been historically. So it's certainly something that, we want to be aware of as traders is, correlations do break. They do break down. They do stop working for reasons just as strong as the ones that they started working for. So, and here's a good example of time frames, right? We talked about different correlations working over different lengths of time. This is Aussie dollar and gold. This is an example of looking at a possible correlation on a longer term chart. Aussie dollar also correlates with gold. You'll find gold is really correlated or inversely correlated with a lot of Forex pairs and other markets as well. Aussie dollar is another one. You've got a lot of mining in Australia. Again, this is a positive correlation, right? So whereas dollar yen was inverse, the Aussie is positively correlated with gold, primarily because of, historically at least, the mining interests and just the commodity dependency as it's perceived of the Australian economy, as goes the price of gold, as goes some large mining projects, as goes the Australian economy. So this is one, though, that, you got to kind of zoom out over long periods of time to see. It's not necessarily a tick for tick, but it is a situation where, if something sharp happens to the price of gold, in the near term, it's reasonable to expect you might see some impact to the Aussie dollar, just depending on the nature of what's going down. Here's another correlation. This is daily. So just again, kind of looking at some different ideas. Most of us don't trade the Chinese yuan, but the Chinese yuan and the Aussie dollar lately have had a pretty good relationship. I've also written about this in some articles on the market news section of Nadex. So this is a good example of, as a trader, and I talked earlier about doing fundamental research, you want to be creative about how you kind of take a trading idea and then you're able to put it into a trade station. I think the yuan and Aussie dollar is a great example. So we're all well aware, should be well aware, that the United States and China have some trade disputes, and Chinese data has been slowing. Their economy is a little more under pressure than normal. I think it's fair to say. I had an article this morning on Chinese GDP was reported slower. The Chinese economy has been slowing. Well, China and Australia are fairly linked. China is a large buyer of Australian commodities. This affects the copper market, bronze, other things that they buy from Australia. They buy just huge amounts of commodities from Australia. So related to that, and this is how the correlation starts to develop, Australia is very dependent on China and Chinese economic health and success to continue to purchase and have a level of demand for their commodities. As China grows, they need more and more commodities, and Australia is a massive producer of some of those base metals and commodities. Well, the easiest way to take that idea, if you're reading an article or you see an analyst article, or you're thinking about ways to trade the Chinese situation, you can use the yuan as a proxy for China, track the yuan, and look at how that might impact the Australian dollar. And then you can build a strategy around, maybe you're following the China-US trade dispute. You've got an opinion, you've got some conviction about how you're seeing that ending up. For the purposes of example, let's say you might think that that's going to continue to worsen, continue to weigh on China, just as a hypothetical. The yuan is really the driver of this correlation, given that it's China purchasing Australian goods is the reason why there's some linkage there, right? So if you see, again, hypothetical example as a trader, this playing out, that China continues to slow, they'll be buying less and less base metals from Australia, that'll impact the Australian economy. You would expect to see as the yuan continues to weaken, and this is yuan dollar, it might be followed down by the Aussie dollar. They might both move weaker in tandem because they're both being impacted by the same economic situation or variable, in this case, the trade dispute between the United States and China, and it's causing both currencies to move south of where they were. And we've seen that play out largely. I remember a few months ago, I wrote an article talking about the Aussie dollar is at like 70.7440, and it certainly moved south in some level of relationship with the yuan. So that's one way to think about, how you kind of do some research, form a trade idea, and then look at ways of translating that into a trade on Nadex.com. And then you can start building other correlations off that trade, right? So this is still the yuan, the blue line, but now we're looking at gold. So now we got, looking at the yuan, which again, most of us don't trade, right? But you got a correlation with the Aussie dollar that we just looked at, and now you've got a correlation and a pretty tight one, in fact, tighter over this time period than the Aussie dollar with gold. Again, probably some relationship, right, between, we mentioned earlier, Australia and gold, and some of this, again, there's more art than science to it, but this is why you want to come at finding a correlation from a couple of angles. You want to see it, you want to measure it. We'll look at ways to measure here in a second. You want to understand it as a trader. So just for looking at, the Chinese trade situation, you've got a couple of different trade ideas, hypothetically speaking, that you've been able to look at here, right? Like you've got the gold, you've got the Aussie dollar. We've talked about then the yen and gold, and then the yen and the Nikkei. There's many branches that you can start to work off of, seemingly really one trade idea that then turned into a possible correlation that you see. Okay, so this is a tighter time frame. So we just looked at kind of weekly and daily. This is euro dollar, Aussie dollar. This is a 4-hour chart, 240-minute chart. We've got our correlation indicator there at the bottom. We've got the candles and the line there on the top. Again, you'll find a healthy amount of correlations just in pairs, with the dollar, obviously, right? Like, not necessarily, I don't need to be a rocket scientist to understand that, but, as you're getting the hang of trading correlations and looking at different strikes and looking at different markets, and if two things both share the dollar and they correlate well based on your own independent research, you can build some trades around looking at different strikes, and two things might be in a different distance to a strike potentially, and you're looking at the dollar, and you expect it to move in a similar way across both pairs. It's a good way to start to get the hang of trading based on correlations, just using a couple of different dollar pairs. So this is an example on a 4-hour chart. Again, holds up pretty well. This is even, now we take it down to a 5-minute. This is, again, euro dollar, Aussie dollar, same pair, same structure here. The candles are euro. The Aussie is the blue line. You can see even on a 5-minute chart, this holds up pretty well, although as you can see there on the right, starts to break down a little bit at that moment in time, which can happen, but pretty strong relationship. Whether it's, again, 4 hours, 5 minutes, or longer term. Okay, so some tools. So I grabbed this from, as you can see, investing.com. Very simple. We'll talk about how to use it here in a second. And this is a way you can go out and determine some of your own correlations that you find. Just, you can do a Google search for currency correlation calculator, or, again, this is on investing.com. It even gives you some nice charting, mobile friendly. But there's 100 of these out there, so just find something that works for you and that you're comfortable with. But you can just select your main pair. Here I've got euro dollar. Choose the time frame you're looking at. Easy drop down. You can measure by a number of periods, and then you can just scan based on that main currency pair. It'll rank different levels of correlations across different currency pairs. So you can see euro dollar in this case on a 5-minute, and I actually did this yesterday. So again, historical data, no indication of future performance, but as of yesterday, a 10-period, 5-minute time frame, New Zealand dollar, US dollar correlated with the euro to the tune of 95%. Pretty strong relationship. Euro CAD, 85%. So you can see how those are ranked and how those set up there just with a simple currency calculator. So earlier we were looking at euro dollar and Aussie dollar. So I said, you want to see it and then you want to measure it. So euro dollar and Aussie dollar is down there kind of in the middle, 72%. As I said, anything above 7 or 70, definitely a solid relationship, in my opinion. But you can see even up from there, there's stronger relationships that you can start to build trades around once you start to kind of understand what correlates well with those pairs. So the other way to do this, and again, I use both simultaneously, is you can just look at a table as well. The cool thing about a table is you can find some tables online that will give you other assets as well. As you can see in this case down at the bottom or far over to the right, you've also got gold. So in this case, you're just going across the top and then you work your way down, and it'll show you the correlation based on the pair or the asset that's on the left. So we were talking dollar, yen, and gold earlier. So we go all the way over to the right. Second from the right is dollar, yen. All the way down to the bottom is gold, dollar. So that's red meaning inverse, or the minus sign means inverse. So dollar, yen, and gold correlates to inversely to the tune of 78%. So very interesting. So again, looking at this table, we can look at some other things that historically correlate. You've got pound yen correlating with euro pound inversely again to the tune of 86%, right? Some of these currency pairs, it makes total sense. I think where this gets interesting is one of two ways. One, you get really good at the currency piece. You understand different movements. You can scan markets and look for possible trading opportunities based on, trading pound yen and dollar yen, for instance. But then also, like we were talking earlier, you've got the Nikkei, gold, yen, Aussie, gold. You can string together some concepts from 3 or 4 or 5 different markets, some of which are not even Forex pairs, that you can use to inform your trading strategy as well. So just in this case with gold, you can see the inverse correlation with the yen, starting to get to an inverse correlation with pound yen, but not as much. Positive correlation there with the euro pound. So interesting to look through all of those. One thing that folks do talk about as well as being another safe haven asset, the Swiss franc. You can see here, doesn't really correlate with gold or with the other safe haven assets as well as I think some folks have historically thought it does. That's really been overtaken by the pound, or excuse me, by the yen. Hence the inverse correlation there with gold. You can see Swiss franc is right on top of the yen. So correlating with gold, that far right column, you can see dollar yen, inverse correlation to the tune of 78%. Swiss franc really only about 40%. Not as strong as some folks would have us think. So in terms of trading correlations, again, our intent and purpose here today is really to give you some concepts that you can think through and start practicing on your own. One way to trade this is to, and this would require a lot of diligence and watching the market, but is to look for when correlations break, right? And typically there would be one unique event only impacting one side of the correlation that would cause it to deviate materially from the relationship, which historically, if it's moving in tandem with an asset, let's take gold and the yen, if there's something unique to Japan, which would not necessarily impact gold and would not be one of their common variables that would impact them as a safe haven asset, you would see a deviation from the yen and the gold, which would be a new direction, kind of a new movement in the price that might be more unanticipated by the markets that you could then build a trade around. So you could just play this more contrarian and look for, when correlations would break. There's also more volatility sometimes in those assets when the correlation breaks because something major has happened. Again, anticipating changes or moves potentially, on our hypothetical example earlier, talking about the Aussie dollar and the yuan, you can hear, in that case, in that example, negative news economically for China may translate to lower moves for the Aussie dollar. So you find a strong correlation or strong pair that's moving in tandem like that, you can then use, and you understand the causality, you can continue to follow a market, know which is leading which, and then continue to build trades around your level of conviction or your opinion on how and when that continues to play out. Again, if they react in similar ways, obviously, but you see one move, the other one might not be far behind. And then exploring different time frames. This is another, just really largely underlooked. But look at correlations over different time frames. Some are really tight, like we talked about, on a tick by tick or 5 minute or 10 or 15 minute basis, and some take place over longer, broader periods of time. So definitely use that TradeStation and charting program and look at some different time horizons. I'm going to pause here and look at some questions. If you've got some questions or some things you'd like me to cover, please fill up our question box here. Would love to hear from you. Take just a second and scan through these here. All right, so somebody's asking about the calculator we showed earlier, the one I grab off investing.com. So I tell you what, and here I'll put my, we'll go to this slide. Just email me. I've got my email address up here, and then I'm happy to send you the link of what I use, or a screenshot of my click path if you're using the app of how I get there. So I think that's the easiest, fastest way. Or if you find a tool you want to share, send it to me. If you've got some questions about some other tools, I'm happy to send it to you. Just reach out, jason@thedutchbook.com, and I'll send you. And I'll send you some other options too. If something just isn't working with your app or your device, there's 100 out there. So happy to share that with you. Thanks for giving me a heads up there. Sorry that didn't work for you right out of the gate. Okay, got a good question here. Can you open 2 different asset contracts on Nadex simultaneously? Yes. So the next step of this, really, today we wanted to talk about some of the concepts and here's some of the tools and socialize that. But yes, you can start to use your imagination and think through, different pair trades. With some of these correlations working, you can absolutely open 2 different contracts across 2 different markets simultaneously. You can open 2 different contracts across different time horizons simultaneously. You can open, again, really, just to be simple about it, if your account is funded, you'll be able to open contracts really, in relation to what's available for you as a trader there. One of the great things personally, just speaking for myself here, I love about Nadex is you can't lose more than you pay for the contract. There's no, trading on margin or leverage where across different markets, you may get, margin call and, kill some of your trades or something. So if you've got the funds available to pay for the trade, you can absolutely trade. And again, it's kind of a part 2 and a deeper dive on this, which we'll schedule for a future session. A couple other things I love about Nadex, really set up well for a correlation-based strategy potentially if it fits within your risk plan and your goals as a trader, is the opportunity to do this across multiple markets, across multiple time frames, from the same platform. So yes, you can set up, again, same time frame, different time frames, different pair trades, so that you can potentially, benefit from some correlated moves with, different opportunities for strikes, etc. Again, totally up to you and as a trader how you build that strategy, but if you're asking that question, I think you kind of start to see some of the possibilities to build a strategy around that. All right, back at my question window here. Okay, good question here. So kind of getting the same thing. When you have a strong positive correlation, do you short one and go long the other? Great question. So when you have a strong positive correlation, the easy answer is whatever you think will work as a trader, because a lot of different things can happen, right? So there are times when, and I'll just speak to this at a high level, but pick a market and imagine this example. So there's times when something happens to a market, and we mentioned earlier, right? Like, let's say it's just hypothetical example here. It's dollar, yen, and gold. And let's say something happens in Japan. Let's say, a bad storm or a flood. We've seen some unfortunate things happen. We had the reactor incident, 6-7 years ago. If something happens to Japan that kind of dents their economy, currency weakens, but it's totally separate from gold. Okay. I'm just truly using a hypothetical example here, but you can kind of imagine how this might be the case. So that may knock your positive correlation that you've seen over a longer time period out of whack. But as a trader, you may say that we know over time that correlation has existed, and as a trader, my opinion is it may come back into balance. So you can go long one, short the other, as if you expect that pair to come back into their historical level of relationship, right? So if you think that, again, just to extend our example, something bad happens in a certain country that's correlated with a precious metal potentially, that currency weakens, it breaks the correlation, but you expect as they come out of that, natural disaster or whatever it is, you can go long the currency and potentially short the metal, and you would benefit from that spread or the distance between the two coming back into what you've seen as its historical relationship. That's absolutely a strategy that many folks have pursued. Not the only way to do it, but certainly one way to do it. Or flip side, the other side of that is you see something coming down the pike that might impact, maybe the relationship is running strong, but you see something knocking it free a little bit. Not that you could predict it, to our earlier example, a natural disaster or something, but you see something happening to one end of the, two things that have been correlated, and maybe you expect the relationship to break and the spread between the two to widen. Again, you could go long one, short the other. If that happens, you would benefit from the distance that they would move apart. Absolutely a strategy that some folks employ. Great question. All right. And to that end, the other side of that is, well, what if nothing happens to the correlation? What if they're just running, it's a strong positive correlation, they're just running strong? Again, this is where I would encourage you sincerely to understand the nature of that relationship. Like I was saying earlier, if it's yuan, Aussie dollar, you may not even be able to trade the yuan, right? You know that one might, or you believe as a trader, your personal opinion and conviction might be that one is leading the other. And so as news would hit China, you would expect that it may be positive or negative. You'd expect that to then, as a second order effect, impact Australia, and then you could, build your trade that way. Again, you're tracking the value of the yuan. You just might not even actually be able to trade it. So another way is if you can truly get to understanding the causality of a relationship, you wouldn't necessarily go long short. You could just go long one or short one based on the primary mover in the relationship. That's another way to play it as well. It really depends on A, your goals and level of risk, and B, how you want to play it, and then C, just the unique nature of the correlation. And I guess to break that down even more, there's a couple of different kinds of correlations, right? Like there's some where it's a common variable impacting two different assets, right? And that was the earlier example with, there's a geopolitical flare-up and demand might go into yen and gold as safe haven assets. But then there's two that are linked more closely, is what we spoke to earlier, euro dollar and pound dollar, right? They're linked by the dollar. Or, my Aussie yuan example, right? Like the mover there is yuan. So just different ways to play each side of that, depending on the nature of the linkage. Great question. All right. Got another question. Got a question about the platform. I would say that there's a question about just different ways trading across asset on the platform. I would say that that situation is uncommon. If Dennis, if you'd email me, and again, I got my email address up here. I'd like to just understand what's happening. I can, get you in contact with somebody that would help you kind of explain or orient to your challenge there. But yeah, there shouldn't be any challenge or any friction in trading in two different markets at once, or anything like that. It should be pretty straightforward. So would love to help you out there. All right, looking through questions. Yeah, so I've got a question about Monday's webinar. If you go to the webinars tab on the nadex.com website, it should be the next one up. We're doing a webinar on Monday. I'm really excited about this one. It's on momentum and trend trading. We're going to look at some actual examples from the Nadex platform just from this week to show you where the strikes were, where the momentum took things, how different ways you could have played it. So please sign up for that if that sounds interesting. Get into some really specific examples there. We'll look at some technical indicators, how they showed up, in the markets this week, where momentum was moving on some different trades. So just go to the webinars tab of the nadex.com website, and then just hit register now by the webinar is called Trading Trends and Momentum with Binary Options and Spreads. Really excited about that one. All right. Well, I appreciate everybody. This will be archived on the YouTube site. Go out there, favorite it, take a look at some other content. Again, would love to have you back for Monday's webinar, look at some trade examples with momentum and trends. Thanks for being a part of this one. Please email me if I can ever be of any assistance or answer any questions, or if you're having some challenges, would love to help you out. do all I can. But more than anything, have fun today. It's Friday. Good luck today. Markets are moving. And, if you haven't, sign up for a demo account, nadex.com/demo. I think it's a great way to try out some of this stuff and just get more acclimated to Nadex as a trader, sharpen your skills, and improve yourself and continue to develop. I'll talk to you Monday. Have a great Friday and great weekend.